us here in the studio. We have Arvind Sanger, the managing partner at Geosphere Capital Management, who joins us right here. Arvind, hi, good morning.
Good morning,
we always speak to you over 7 Seas, so it's generally hard to sort of get the mood. But now that you're right here with us in the studio, Merry Christmas to you, first of all. And what's the mood like on equities?
Well, I think the mood on equities is generally, it's been a tough year, and I think looking at 2016, we're optimistic that it'll be a better year. Okay. But I think that as far as India is concerned, I think I've said this before. I see some green shoots, and I think those green shoots should hopefully build. And those green shoots, let's be clear, are not because of anything going on or not going on in Delhi. They're because of what's going on in the broader economy, and and I think people get excited about things like pay commission. But I think at the end of the day, pay commission, was always expected, and people used to get excited about Narega, and then we figured out that Narega was not so good. So just government transfer payments are not what is exciting. What is exciting is bottom-up consumer demand, some productive parts of the economy recovering, whether it is auto demand or more importantly commercial vehicle demand, or roads backlog in orders, or electricity demand, or even passenger traffic as far as airlines are concerned. Those are all signs of increased economic activity, and I think that's all good signs for the virtuous cycle, as I like to call it, of economic recovery. And I guess I've always believed that unfortunately the base effect of the new data series on GDP has been one of the worst things that happened to India, because it has created complacency that, we are growing the fastest in the world, we're growing at 7.5%. So there's no urgency to do anything. The unfortunate reality is under the old data series, the growth rate has been as disappointing over the last 3 or 4 quarters as it's been over the last 5 years. So, that's been part of the challenge for the Indian markets, is no matter what the headline GDP is printing, the company earnings are not printing anything to be writing home about. And so the optimism about 2016 lies in the fact that whether it's in the December quarter earnings or going into next calendar year, we're expecting the earnings cycle to start generating some upgrades, and that would be the single biggest, I think, factor for the market.
I don't think anybody is being taken in, not the policymakers, by that 7.5% number at all. They like to use it for sloganeering. But if you saw the financial stability report yesterday that came from jointly the Reserve Bank and the other regulators, it's scathing on the extent of indebtedness and the terrible position of the asset book of banks. So nobody's lost sight of the fact that corporate India is also beleaguered in certain parts. But I want to get 2 big themes out of the way first. And we've been discussing this with our technical guys as well, the last 6 weeks have seen a fairly decent resurgence in metal prices. The LME is back to its mid-November levels after touching, for instance, copper going all the way down to almost $4,000. It's now rebounding rather smartly. Is metals a place you would look at all, at least as a tactical buy?
I would say metals is probably very small moves tactically, but I think that the steel sector, for instance, and everything affiliated with the steel sector in China is in so much overcapacity that any rallies that come are going to be short-lived. Some of the other metals, I think, like copper, are closer to where the marginal cost is there. So therefore, you may have, you may be bouncing along the bottom. But for any big resurgence, I would say that's probably not at the top of my list for 2016. On the other hand, the one that people have given up on, which is oil, I think is going to be, and frankly, we've been surprised by how low it's gone. But I have a very simple rule of thumb that the lower it goes, the sharper will be the rebound when it happens. And so, I think that, if I were to pick, is going to be the single best performing sector globally in 2016 is oil, because I think oil is going to be, we'd be lucky if it stops at 60 on the way up, and therefore that's a big call that I'm sticking my neck way out on, which is a very non-consensus.
Okay, so $60 on the way up is what you're expecting on
at the minimum.
At the minimum. By when?
By the second half of the year.
Okay, fair enough. You know, it's good to hear that you're talking about some green shoots in the Indian economy, because we sitting here sometimes don't get the best bird's eye view of what's happening. So this time when you've traveled to India, what have you noticed differently from the last time? How have things picked up?
Well, I've just been here 24 hours, so I haven't had a chance to travel around. I am going to be traveling around, and I can tell you more about it. And then, after my meetings, both this afternoon and over the next few days, that I come back with. But as I mentioned earlier, I think the data series that we're seeing, which has nothing to do with the meetings that I've had, are showing that what I'm hoping to hear. If you ask me what I expect to hear, I'm hoping to hear from more corporates across at least a few of the sectors about green shoots. I don't know if the cement sector is yet ready to say it yet, but I know I'm meeting with road companies, construction companies. I expect to hear more of that. I'm meeting with some of the companies in consumption. Urban and rural consumption based a mix, but I'm expected to hear more about the urban consumption side of the story, more green shoots there. A couple of areas where I remain somewhat cautiously optimistic but don't see signs yet is the banking sector. I think the banking sector is a very big one, and there I would hope we would see signs that that the loan demand is starting to turn. Obviously, it's going to be the private sector banks that are going to lead the way. The public sector banks are clearly way too indebted to be, not indebted, but way too much in trouble with the indebted corporates to have the same green shoots show up for them.
What about consumption? Is that where you would look for buys?
Absolutely. Well, the problem with consumption in the broader sense is that stocks are not cheap.
I was going to say that. They're all at 30, 40 times.
Yeah, the FMCG stocks and the consumption-oriented stocks. So one has to find, ways to play the consumption story without necessarily having to pay an arm and a leg. And, maybe it is autos, maybe it's two-wheelers, which have been disappointing for a while. CV is doing well. That's an area of consumption that is not consumption, but it is. But so the question is, are there urban consumption stories which are available at reasonable price? And that's one of our challenges, is finding special situations where one can find that.
Okay. Well, just talking a little more about the reform momentum. This morning we have Coal India, which is one of the biggest gainers, because overnight we've had news that there's a big JV with the Indian Railways that Coal India has signed. So rake availability will now increase, thereby increasing offtake as well. Is this a space that you would be bullish on?
Coal is one of the most oversupplied commodities in the world right now. So I guess to the extent that Coal India has pricing, which is there are companies going bankrupt in the U.S. Every month. One company goes bankrupt. Australian coal prices are collapsing. Chinese coal prices are collapsing. So fixing coal availability in India is a great 2013 solution, which is not a 2016 problem.
Too little, too late?
Too little, too late. I mean, right now the problem in the power sector, we'd love to invest in companies that benefit from the overall reform of the power sector, but the solution is not coal availability. The solution is fixing the State Electricity Board, their indebtedness, and there is this project, I forget what the new acronym, Uday.
Yeah.
So there's always a new acronym. It used to be APDRP 2, whatever, and now it's Uday. I'm tired of acronyms. I'm looking for action in the ground, and I'd like to see, and we'd like to see, actual. The tragedy of India is that on the one hand you have surplus coal availability, surplus power availability, underutilized power infrastructure, and you have massive power shortages on the other side, and you have companies which are generating power at 3 times the cost of what they could buy from the grid, and you can't figure out a way to get the two sides to meet, and that's a huge economic loss to the country. Unless that gets tackled, that's one of the low-hanging fruits.
So power is not what you're buying now. You will wait to buy.
We've got a small little kind of exposure to it, but it's one that we'd love to have bigger, because it's one that doesn't require legislative action. It requires, some hard-headed decision between the state and the center, but they both should be on the same side on this in terms of wanting to fix it. So I think that's an area where we look for things, but unfortunately so far it hasn't happened. And banking sector, PSU banks, if they fix some of the problems there in terms of their own bad debt situation and their availability of capital adequacy to be able to lend again. But I think on the other hand, the demand side, so meeting with the private banks will give a sense when the demand story turns. I think those are two big areas that we've been emphasizing for several months now, that the government, we need to see more visible action that'll help some of the green shoots grow much faster.
You know, the 2015 was actually a year of mid-caps. Anuj was giving us an interesting formula yesterday. If you had put your money in the top 10 Nifty stocks and the bottom 10 Nifty stocks, the top 10 would have given you a gain of 19%, but the bottom 10 would have taken away 38%. So net you would still be at a loss. Whereas in the mid-caps, even if you had put the equal amount of money in all the 100 mid-cap stocks, you would be 24% in the money. So is 2016 also the year of mid-caps and avoiding big boys?
Well, I'll tell you, just for our experience, we had decent positive returns in India because we largely own mid-caps. Because as I say, India is a story of bottom-up. And in the bottom-up, the segment that you're talking about, we're looking for companies which are showing growth in their niche, whether it is because they're gaining market share at the expense of somebody else, and it may be an NBFC, or it may be a company in the commercial vehicle space, or it may be a company in other parts of the economy, including one of the cement stocks that we've done well with. So I think that it's really a story, has remained in 2015 a story of bottom-up mid-caps. But I would think that if the green shoots that we are right about do work out in 2016, then it could turn into a broader-based benefit for the overall market, and it may not remain. I mean, it doesn't mean that the mid-caps won't do well, but it means that some of the broader sectors may start to work, but it still remains one where one has to pick the right company in the right sector to make money, because there isn't a visible macro story. And frankly, if I'm right about oil prices, that could remain one possible macro challenge. I don't think it derails the Indian economy if oil goes to $60, $65 or $70, but I think it would remain a potential thing to to manage in terms of the inflation story and some of the easy gains that the government has been able to do on the budget deficit side because of all the increased taxes on petrol and diesel.
Okay, so before we let you go then, if you had to, you did say that 2016 is expected to be a better year than 2015, but if you had to wear a guessing hat, what would you guess? By the end of the year, where will the Sensex be?
Well, I pay attention to the Nifty, so I'll give you my Nifty target. I would say that by the end of the year, we would expect Nifty to be, in the mid to high 8,000s. Okay. So that should be, a nice recovery.
That's not very far from here.
That's not very far from here.
You don't have a very bullish
I remain a bottom-up view because parts of the Nifty or the Sensex are not areas where we see as much excitement. So I think, if we got to 9,000, that would be probably a really good year in our opinion in the index. And again, I talk about oil and others as being headwinds for a broader sector, but I think making 15 to 20% return in investing in individual companies in India remains a much more believable concept than making a Nifty or
index
a Sensex bet and talking about 15 to 20% returns on the index.
In any case, we will take it with both hands. You're expecting a 10% rise in the broader markets as well, so you can't go wrong with that, even if you bought right. Nifty Bs. Arvind Sanger, it's a pleasure having you with us in the studio, and have a great 2016 yourself.
Thank you.
And the next time we speak with you, we'll ask